Welcome to AdventureTerrainVentures.com. This is Oral David, and I'm here to make another video today. Today we're going to talk about demand and supply on a candlestick chart, and we'll also look at indicators and oscillators. Do they really help, and how can we use this in our trading? So what can you see here on this price chart? This area over here, can you observe that prices have been moving in a very narrow range, sideways? So we call this a period of consolidation. You can also call it as equilibrium. Prices are moving in a very narrow range, means that demand and supply are in balance. But immediately after that, we see a sharp drop in price. What does that indicate? This indicates that suddenly over here, a lot of selling came. The supply exceeding demand. That's why the prices dropped. Make sense? So this period here is a period of equilibrium, and this period here is a period where supply exceeded demand. Now as the price kept dropping and it reached over here, again for a very brief while the fall was paused. We got into a period of equilibrium again. And then we see the price rise sharply again. So again, we have a period where demand exceeds supply now, because we see a rise in price. Now when the price reaches back to the same area where a lot of selling started, we know that this is a place where a lot of selling happened. And due to this very sharp fall in price, a lot of selling could not have happened. And a lot more selling could still be in the cards. A lot more sell orders could still be waiting to get filled around this price level. So that is why you see, as soon as price gets back into this area of supply, prices turn and start moving down again. And since at this area, we know that demand exceeded supply. How do we know that? Because prices rapidly shot higher. So this area is an area of demand. So when price revisited this area of demand, again you see prices turn and start moving higher. So this is a phenomena where prices keep oscillating between areas of demand and supply till the demand and supply has exhausted. Now this kind of a fall in price, could it have been caused by retail traders selling, or do you think it's because of the institutions or the big boys? See, I would like to classify the traders in the market into two categories. One, the institutional traders or the big boys, and two, the retail traders, or I also call them the novices. Why? Because the retail traders, the bigger portion of them are the novices, and a smaller portion are the professional traders. So institutions are the ones who make the market go up and down. The way they play, none of us can actually play because it's all power of money. We would do good if we try to follow the institutions. The retail traders are those who usually end up losing money, and the institutional traders are consistently making money. So whom would you like to follow? Obviously the institutional traders. These novices or the retail traders consistently are losing because they are consistently making mistakes while they trade. And let's see what are those mistakes that novice traders make. They make two key basic mistakes always, and consistently they make these mistakes, and that's the reason they consistently are losing. The first mistake a novice buyer makes, he always buys after a rally in price. And mistake number two, he usually ends up buying at a place where supply exceeds demand. These are the two common mistakes that all retail traders make. And there are two mistakes that the retail sellers make. They always sell after a decline in price, right here. And they end up selling at a place where we know from a price chart that demand exceeded supply. So if we need to be a profitable trader, what do you think we should be doing? You're right, exactly. We should be doing exact opposite of what the novices are doing. So if the novices are buying after a decline in price, if the novices are selling after a decline in price, I should be buying at that point. So usually I buy in an area of demand when price revisits that area. And we should be selling at a place where supply exceeds demand. And that's the place where the novices are usually ending up buying. So to be a professional trader, do exactly what opposite the novice traders are doing. If you have watched my last video, you will remember this price chart of Oro Pharma. So I was in this trade last week, and as you can see now, the very beginning of this week, I exited my trade and my target was reached. So let me now show you another trade in Oro Pharma which I took this week. Yeah, here it is. This level that I marked here is a level of supply. Why is it an area of supply? Because we see here a period of equilibrium or a period of consolidation followed by a sharp decline in price. So this area is an area of supply. So I placed a sell order at 620.85, kept my stop loss at 625.50. So looking at this price chart, I know that $620.85 is a price where novices are going to be buying. Why? Because at that price, they will be buying after a rally in price. And secondly, they will be buying at a price level where supply exceeds the demand. So that's the price I go short. And as you can see, price came into that price at the end of the day. And very next day, it opened there and fell within no time. Why? Because there was a lot of selling at this level from institutions. Now let's see what happens if we add some indicators to this chart. Most people trade using indicators and oscillators. So one such indicator which is very commonly used is a moving average. So let me just take an exponential moving average for 20 periods and apply it on this chart. And let's see whether it is really useful to look at a moving average. Now what this curve that has come onto the chart is the 20 period moving average of the 15-minute chart of Auropharma. As you can see, when prices are falling, the moving averages is also falling, and when prices are rising, the moving averages are also rising. So it is a very common practice among all these novice traders to just put up this moving average on the chart, and whenever it is sloping downwards, they start selling, and whenever it starts sloping upwards, they start buying. Can you make money by following this method? Probably you can. It works well when markets are trending. Okay, but when markets get into a sideways mode, it can give you a lot of wrong signals. And usually in areas of demand and supply, they would be always contradicting. Why does that happen? Because moving averages usually lag price. What do I mean by lag price? They start moving in the direction of price much after prices have turned. So just take this example for that matter. As you can see here, prices have been moving higher and the moving average is also sloping up. On this candle, the direction changed. It started moving down. But when did the moving average actually start moving down? The moving average actually started moving down right here. Now, if you wanted to start selling after the moving average gave you the sell signal, you would end up selling somewhere over here at this price level, not over here. So as you can see, by following demand and supply, you can actually enter at the top, or at least somewhere close to the top. May not be the exact top, but at least somewhere close to the top you can sell. And same goes with demand. You can end up buying close to the bottom. Did you notice that this sell transaction that I did is very close to the high of the day? So moving averages are lagging and are not very useful. What about using an oscillator? Let me just put one oscillator on the chart. I'm sure you would have heard of this term, Relative Strength Index, or the RSI. So if you just look at this oscillator which has come down here, called the RSI. RSIs are very good for sideways markets, but they tend to give false signals when the markets are trending. So if you see here, during this period, the market was trending up for a pretty long time. But if you end up following the signal of the oscillators usually are, people usually sell when it is in an overbought zone, and that is on the top, and they start buying when it's in an oversold zone. So if you notice here, as soon as price went slightly up, our oscillator went already into an overbought zone. If you started selling here, you would not make any money, you would be losing, because price continued going higher. So these oscillators tend to be in an overbought zone for a very long time. So it can be a bit tricky if you are going to follow this oscillator. But they can be used in conjunction with demand and supply. So whenever an oscillator is in an overbought territory, and if price is also in an area of supply, that's when you can actually think of utilizing the RSI. So in this chart, when price entered the area of supply, our oscillator also got into overbought territory. If you can see its value, it's above 65. So you can actually use these RSI or any oscillator for that matter. RSI is not my favorite, and I don't use indicators and oscillators for my trading. But if at all you want to use it, this is a way you can. Simply take those trades when RSI goes into overbought or oversold territory in conjunction with demand and supply. So how do we do that? So if RSI is above, say, 60, it is considered to be in overbought, and if price is in an area of supply, go short. Conversely, if RSI is below 40, where it's considered to be at oversold, and you see price also in an area of demand, go long. So now let me take you to another trade which I did this week. This is in REC Limited. So we have this period of consolidation, then we have a sharp drop. I just marked this area of supply. Now when prices started coming back to this area of supply, I know two things. One, that novices are buying over here. Why? Because they usually buy after a rally in price. And the second thing is they buy at a point where supply exceeds demand. So what did I do? I went short at this price at 112.55. Prices turned, came down, and in the same day gave me my target. Now if you look at the moving average, again it is sloping upwards at the price at the point where I entered. Usually the retail traders would not go short over here. They would wait for the moving average to turn and start moving down. By that time, if they had entered it somewhere here, it had already come halfway down to my target. What is the oscillator doing here? As you can see, in this area of supply, my oscillator is in an overbought territory. So I can use the RSI in conjunction with demand and supply to enter long and short trades. So finally, before we close, let's look at the chart of the Nifty. I'm sure you remember this supply zone which I had marked last week, and as well as this demand zone which I had marked last week. So prices once touched this area of supply here and dropped. Then again next week it went up deeper into this area of supply. And as I mentioned last week, we are expecting that it will drop from there. It did drop, and it's come almost halfway close to this demand. We can expect prices now to touch this area of demand before it can start moving up and breach this weakened area of supply. Why do I say this area of supply is weakened? Because we already have 1, 2, and 3 touches to this area of supply. So it's very unlikely that this supply area would hold, and taking short positions at this time may not be a very good idea. But I would like to see prices coming here to this area of demand, and if it does come, I would think of taking long positions. However, if it didn't come here, let's say the supply area straight away got breached and went higher, in that case what would I do? I would then look for any new demand zones that are formed and then buy when prices retrace back to those demand zones. So that's all for now. May all your trades be green. This is Oral David here signing off. For more details on any of the courses that we offer, there is a course called StockMarketModelStreet. So for more information about this course, visit the website, that is adventureterrainventures.co.in. Thanks for watching.